Hi everybody, this is Jeff Gibby. I'm going to do a little bit of a demonstration, talk to you a little bit about the turtle trading system. Pretty excited to do this one. If not the most famous strategy in existence, it's certainly one of the most interesting stories in terms of the turtles and how they began and all that kind of stuff. So I'm going to go through the rules today. I'm going to tell you a little bit about how the turtle trading system got started and why it's so famous and all of that kind of stuff. So let's go ahead and get started. The turtle experiment was really something that was put together as a gentleman's bet between Richard Dennis and Bill Eckhart. Richard believed that that traders could be taught to trade, while Bill kind of believed the opposite, that trading was a genetic thing. You really couldn't teach people how to trade. And so they formed a bet. These were two very, very famous traders. And they formed a bet basically saying, can we teach traders how to trade? And so here's kind of how the story put together. They took out an advertisement in the Wall Street Journal, the Barron's, the New York Times, and they basically said, if you want to trade for us, we'll give you a 2-week training class. We'll give you a little bit of training. We're going to fund you your trading account, and we'll let you trade. The only rules are you have to trade our strategies. You have to trade our rules. You have to follow them exactly. And as you might imagine, they had a huge amount of interest. They ended up selecting around 55 traders, and they would put them through a 2-week training session, and then they funded their accounts for between $500,000 and about $2.5 million, depending on kind of how much they decided. I don't know how they allocated the funds, but they basically funded them a trading account and set them to trading. And it was remarkable, the results. Generally speaking, it was the most famous trading experience in history. On an annualized basis, these traders made 80% per year. And it was quite humbling to Richard Dennis. He basically said trading was much more teachable than I ever imagined. And in a strange way, it was very, very humbling. They were able to kind of take these people off of the street and basically turn them into what they called turtle traders. The other thing that he did say as a result of the trading scenario is they really took every single aspect of the trading and they broke it down. If this happens, then you can trade. This is how much you should buy your account for. This is how much you should sell your account. And Richard always believed, and this was one of the quotes from The Market Wizards by Jack Schwager, but he said you could publish his teaching in the newspaper, but no one would follow them. The key is consistency and discipline. And you'll notice as I show you the turtle trading system in MetaStock and how it works, that it is a system that fails on entry very, very often. In fact, it fails a lot more often than it actually succeeds in giving you a profitable trade. The key was the consistency. And the reason that they made the traders follow their rules is because those traders would have to lose 4 or 5 or 6 times in a row, and they'd have to be able to put that 7th trade on and be able to follow that entry signal. And as long as they did, overall, they'd make money. In fact, they'd make a lot of money. And so let me go ahead and go into MetaStock now. I want to show you exactly what the trading rules look like and what they were doing and that kind of stuff. Let's go ahead and go into that part of the presentation at this point. Okay, so here I'm looking at MetaStock, and I think you'll be amazed as I was when I kind of show you exactly what the entry signal for the turtle traders are. I do want to give a few disclosures here. Number one, I'm showing you the technical aspects to where they would enter and exit a trade when they were turtles. There was a lot more rules that kind of decided exactly how big of a position they would take, how they would manage risk, and they really managed risk by the size of the position they would take. They had rules around how many commodities. They were commodities traders. They were allowed to buy. They had rules around how they were diversified, and certainly it's beyond the point of this demo to kind of go into all of those rules. Michael Covell does have a really good book on the turtle method. If you're interested in understanding exactly the way the turtle is actually kind of position sized and money managed and all that kind of stuff, I'd recommend that you pick it up. Okay, but let's talk a little bit about how the turtles entered a position. I've put an indicator on here that's basically called the Donchian channel. And it's very simply, if we were to go and look the last 20 periods and draw the very highest point in the last 20 periods, you'd have the top of your Donchian channel. And then we would do that for the the low of the thing would be your low point for the Donchian channel. So wherever that happens to be, those were the specific levels that the turtles were looking at for entries and exits. So in other words, if it broke up through a Donchian channel, basically they would use that as a buy signal. If it broke down below a Donchian channel, they would use that as a sell signal. I think it might be easier for me to actually show you how that works by actually attaching the expert advisor to the chart. So what I'm going to do here is I'm going to go ahead and click on the expert advisor. I'm going to go down, and it's actually called MS11 Turtle Trader. So I'm just going to find that on my list here. I'm going to go ahead and attach it to the chart. I'm going to go ahead and click on close. And you'll see that every time there's a penetration of this value, it's going to give us a sell signal on the chart. Now they would phase into conditions. So in other words, if they're in a long position, like they'd enter a long position here, and they got another long signal, they'd buy again and again. But there was a limit to how many different actual trades they'd take in a certain direction, and it depended on the commodity. Again, when they set up the experiment, Richard left nothing to chance. They took all of the important rules out of the discretion of the trader and put them into a method, and with very, very good success. So let me go ahead and what I want to do now is I want to go ahead and go into the commentary for this and just help you understand exactly how the systems would work. You'll notice that we also have stop triggers that come in on the chart. I want to show you how those work as well, and kind of how you can kind of use the commentary to kind of help you understand the turtle trading system a little bit more fully. Okay, so I've attached the expert advisor commentary. Here again we have the arrow that points down on the chart, and that means that we're looking at the most current day. And there is an important note that comes up. The original turtle trader system only allowed for entry trades, so a new buy trade if the most recent entry trade was a losing trade. Now, if it was a losing trade and they didn't take it, they'd still take the trade, but they were looking, this is at heart a breakout system. It's looking for a breakout into a new trend. And so they were very, very specific that if the last trade, let's say this trade right here, they got in and they actually lost money on it, then the next signal would be valid. And even if they didn't take this position because of that rule, they would take the next position because this would have been a valid trade based on the rule. It would have lost them money, and then they can go ahead and go long on the next position. Okay. Now again, they were very, very specific in terms of their position sizing to manage risk. And the way they'd actually tie risk in is they'd tie it to the volatility of the instrument. So, and they did that with position sizing and an average true range and something that they called N. Okay, N is a measure of volatility and the particular stock. So when we got this buy signal in MetaStock, what it's actually calculating for us is telling us there's a 20 bar breakout and that a buy signal occurred. This is a valid one because if we look at the last sell signal, it would have lost money, so we can go ahead and trade in there. It's also going to tell us, based on the volatility of the stop, that our sell stop based on N would be 128.97. So if we're going to go ahead and buy this, we would put a stop price at 128.97. The other stop that they also used was a 10-bar sell price, and that's a value of 127.47. So those are the two stops that you would use. Now the turtles were very, very specific about not actually putting the trades in because they moved a lot of volume through the markets. They didn't want to give signals to the money markets or the other brokers or things in terms of what their system was doing. So they kept them on paper, but if the price ever penetrated either of these levels, they weren't negotiable. They would go ahead and get out of the trade. Okay. As time goes on, it's going to give you more feedback in terms of how that system works, and your stops will update. If you stage into another position, that's actually a key to move both stops. So when we get into another signal here, remember we're in a trade. According to the Tudor rules, we could buy another position, and in that case, actually our stops would move, and the MetaStock program will actually calculate what those levels should be and where to move those to. Again, a very interesting system, very, very successful. Something that actually made them famously rich. And maybe famous is actually the key word. They actually were very, very famous traders. Let's go ahead. I do want to show you just a few things. There is a system test, so if you like the turtle method, it's not actually my favorite method to test. You can go in and test to see how well it works and determine what stocks work best for it. If I click on the last report that I run, it's going to give us a little report that we can look at. And again, it's not a terribly profitable system, but once you start to apply the money management rules, we will. And the system, the grains and the things that they were trading actually worked really, really well. It looks particularly well, like it worked well on this Warner Cholin PLC, which had 107% profit with 8 trades, 7 winners, 1 loser. Most of the time, though, the turtle trader would generate a lot more losses, but they were little controlled losses, and that's why the system worked really, really well. And that's basically what made him so famous. I hope you enjoyed the story on the turtle traders and how their system works and how their method works. Thanks for watching.